Welcome back to London. We're going to catch up with Akshay Kapoor now from Gekko Global Markets. Remember, last time he was predicting a collapse of the assets markets. Well, now we're going to pick up that conversation. On some points you're making last time you basically said you're expecting a collapse of asset classes. But I just want a bit more detail what you expect. How do you expect it to manifest itself, and how deep do you expect that collapse to be?
I think what I said last time was that central banks have infused too much liquidity in the market, and the normal gravity effects of the laws of economics will take hold and something will give. So I think what's going to happen is that we will see anywhere between 10 to 25% drop in asset prices probably in the next 6 to 9 months. This would be across asset classes, albeit different asset classes would move at different speeds. And I think at that stage, depending on policy action, one of two things could happen. Either policymakers compound their mistakes by again misdiagnosing the problem and again pump priming the system, which will again reflate asset prices, but will create a larger problem to be solved for the future, which would mean a bigger readjustment in the future. Or maybe people start doing the right things, which are supply side reforms. Now, frankly, I think the possibilities of the latter is about 10-20%, because it's not human nature to address problems and resolve them. So I think what will happen is we'll see a drop of about between 10 and 30% of asset prices in the next 6 to 9 months, after which deflation will happen again, driven primarily by policy action.
So if we run with that scenario from an investor's point of view, where should they be looking to put their money? Just stuff it under their mattress, just buy gold? What are the opportunities?
Well, that's a very good question. I think it depends upon the investor's risk appetite, their risk preference, and their time horizon. So let's take an average investor, for example, who is risk neutral. I think the first thing that they need to do is to look at the asset allocation very carefully. As of now, starting as of today, I think an asset allocation of somewhere between 30% in assets and 70% in cash is a good place to start. So if you're over-invested in markets, if you're overweight in markets, I would suggest lightening up. Lighten up on any upticks. Use opportunities to hedge your positions, buy volatility, and in general be in cash. But obviously not all your money under the mattress. And I would certainly not recommend investors keep all their money under the mattress for long periods of time, because I believe that inflation will come, basically because of central bank action, and during inflation you definitely don't want to be in money.
But if we do see a high rate of inflation, is it a case of just buying gold? Because gold seems to be the natural hedge. There must be something else, because there's only a limit to gold's ability to go up. No, absolutely. I personally am a gold bull, and I think holding physical gold is a good hedge against inflation. But there are lots of issues with holding physical gold. It's expensive. You pay much more than the market price of gold. You cannot transport it easily, and there are obviously issues on security, right? So the other alternatives are you buy an ETF, but again, with ETFs, you've got fees. The other alternatives are actually you could do CFDs or spread bets with somebody like Gekko. And we've got some revolutionary new products, but we can talk about that later. So I think gold is an excellent alternative, but obviously I don't think investors should have more than 10% of their portfolio in gold, and as far as possible keep it in physical gold. The other long-term good hedges against inflation are obviously buying equities, because when you buy equity, you basically buy a stake in a business. So if inflation is going up, then prices should go up, and if you have a stake in a business, equities are good. Property, and obviously if you can afford it,
yachts, any luxury assets that are used by the elite will tend to typically go up during major inflation, unless there is a major war or something of that sort.
The S&P 500 has gone up by about 16% in the last year. Do you see much? Do you see no more room for it to go up any further?
I think if you look at the S&P 500, I think it is basically trading at somewhere around 14.5 times earnings in terms of 2012 earnings. So I think 2012 earnings were about $88. Dividend is about $30. So that takes it to just about 110 or so. And it's been discounted by it's trading at about 14 times the earnings. We saw a high of around somewhere close to 1475 on the S&P 500 in mid-September. Now, if you remember, in mid-October 2007, we had seen a high of about 1570 or 1580 on the S&P, which had corresponded to about 14,000 on the 14,400 on the Dow. And yes, I absolutely believe that that's the top. It could well touch 1470 again. There are some people calling for it to go well above 1500. I definitely don't think that would happen. So what I would recommend investors to do is to start lightening up on any upticks. If it goes to 1470, goes to 1500, go short. Go short big time.
So if the S&P 500 is not looking so attractive, is there an argument to look at more emerging markets like China?
I think that's a good point, Peter. But if you permit me, I'll just go back to a question you asked me a while ago. How do I see this collapse playing out? So as I said, in the near term, in 6 to 9 months, I expect asset markets to go down by about 10 to 30%. And after that, anything may happen. They might reflate again because of much more quantitative easing, or sensible policies start being put in place, which would also give cause for markets to go up again. And at that stage, I'd strongly recommend investors to buy. However, if you think that markets are going to go down significantly, one needs to think about the triggers for that. So there could be 2 or 3 triggers. One could be geopolitical risks. The other could be some bad news from China. Thirdly, could be the Eurozone. And I think markets would react differently depending on what the trigger is. And this brings me back to your recent question. If the trigger is China, if there is bad news from China, then I think emerging markets will go down quite sharply. But if there is no bad news from China, then I think it is probably a good idea to be invested in China, for example. I mean, as you know, China, the Shanghai Composite Index saw a 3-year low a couple of weeks ago, if I'm not mistaken. So there might be value opportunities in China, though I would still hold on.
That's all for the moment, but stay tuned to Dukascopy TV for more news, analysis and the odd cartoon. But for now, goodbye.